Hello, everyone, and welcome. Today, we are diving deep into the magical, complicated world of the Walt Disney Company. Now, on the one hand, if you look at their finances, it seems like a massive comeback is underway. But on the other, there's a technological storm brewing that could shake the company to its very core. So, what are we looking at here? A true renaissance, or the slow fade into becoming a relic? For the last few years, all the talk around Disney has been about streaming losses and cultural squabbles. But that whole story is starting to change, and fast. So first, we're going to break down just how powerful their resurgence really is. Then we'll see how they stack up against the competition. And finally, we're going to pivot to the one massive, maybe even existential threat that's looming on the horizon: artificial intelligence. All right, so let's start with the bull case for Disney. The good news. From an investor's point of view, the company is really starting to look like that stable, cash-generating empire we all knew. And trust me, the numbers are telling a very, very compelling story. Okay, this slide right here really lays out the comeback in black and white. Their price-to-earnings ratio, which is basically what the market thinks the company is worth compared to its profits, is sitting around 17x. That's actually pretty attractive next to its peers. Wall Street sees a potential upside of 20, maybe even 40%. And look at this, they're rewarding shareholders with a huge $7 billion stock buyback and a dividend that's on the rise. This does not look like a company in crisis. This looks like a company that is seriously getting its financial house back in order. So, where is all this financial muscle coming from? Well, you can think of it as a kingdom with three main pillars. You've got entertainment, that's streaming and the movie studios, and you've got sports with ESPN. But the absolute titan, the economic engine that's really driving this whole machine, is the experiences division. We're talking parks and cruises. That is the bedrock of Disney's power right now. Just look at this number, $10 billion. That's the revenue they pulled in from parks and cruises in a single quarter. It was a record high. And get this, even with price hikes, people are still showing up in droves. This isn't just one part of their business, it's a financial fortress. It's the cash cow that gives Disney the stability and the breathing room it needs to figure out everything else. So how does that stability help their other divisions, like streaming? Well, for years, the entire streaming game was about one thing and one thing only. How many subscribers can you get? It was a war. Well, that war is officially over. Disney has made a huge pivot. The new game? It's all about profitability. They are done chasing growth at any cost. Now they're laser-focused on turning streaming from a money pit into another one of their cash-generating machines. But of course, Disney isn't operating in a bubble. And when you look at the competitive landscape, you really start to see just how different their strategy is from their biggest rivals. And this is where the story gets really interesting. So here's the bottom line. When you look at Disney versus Warner Bros. Discovery, you're looking at two totally different kinds of bets. With Disney, you're betting on stability. You're putting your faith in those physical parks, that incredible library of IP, and a steady return to shareholders. With Warner Bros., you're not really betting on their business today. You're making a high-stakes gamble on an event that someone, maybe Paramount, is going to swoop in and buy them out at a huge premium. It's a classic M&A gamble, high risk but potentially high reward. And nothing shows this difference more clearly than this chart. Disney is valued at around 17 times its earnings. That's a reasonable number based on actual profits. Warner Bros., it's valued at over 100 times its earnings. That's insane. The market isn't pricing Warner based on its performance. It's pricing it based on the hope of a massive buyout. If that deal doesn't happen, a valuation like this could absolutely collapse. So what about the OG disruptor Netflix? Well, after they decided not to buy Warner Bros., they've really carved out their own lane. They're all about capital efficiency now, building up a massive advertising business and pushing hard into live events like sports and stand-up comedy. Honestly, they're playing a completely different game than either Disney or Warner Bros. At this point. So we've painted the picture, right? Disney is the stable giant, Warner is the high-stakes gamble, and Netflix is off doing its own thing. But now we have to talk about the earthquake, the one that's about to shake this entire industry right down to its foundations. Think about it. For the last decade, the entire battle in media has been about one single thing: getting you, me, all of us to pay 10, 15, 20 bucks a month for a streaming service. Every single strategic decision was built around that one goal. But what happens when the very ground beneath your feet shifts? The threat that's coming isn't just another streaming service. It's a technology that could fundamentally devalue the core assets, the very things that make these companies giants. The next war isn't going to be for market share. It just might be for survival. And it all starts with this idea, creative deflation. Just try to imagine a world where making a beautiful, high-quality animated movie or a mind-blowing special effects sequence doesn't cost hundreds of millions of dollars, but maybe just 10% of that. AI tools are right on the verge of making content creation incredibly cheap and incredibly abundant. So why is this an existential threat? And why specifically for Disney? Well, it's because Disney's entire empire, its whole kingdom, is protected by a deep, wide moat made of valuable, rare, and very expensive to produce intellectual property. And that moat, it's about to start drying up. This quote from one of our sources just nails the problem perfectly. For all its creativity, Disney is not a fundamental technology company. It's a content company that uses technology. It's an incredibly wealthy owner of IP that goes out and buys the latest tools, but it doesn't build the fundamental tools. And in the age of AI, the real power belongs to the ones who build the tools. So let's just run through the threats here because they are huge. First, democratization. When anybody can type a sentence and generate a beautiful animated film, Disney's huge production advantage just shrinks. Second, IP depreciation. What happens to the value of Mickey Mouse when an AI can dream up a million new, incredible characters overnight? Third, fading scarcity. Why would you spend thousands to fly to a physical park when mixed reality can bring an amazing, immersive experience right into your living room? And the biggest threat of all, what happens when an artificial general intelligence can write stories that are more compelling, more personal, and more moving than anything a team of humans at Disney ever could? And all of this leads us to the ultimate question facing the company. In this new world that's coming, what does Disney become? Does it stay a living, breathing part of our culture? Or does it become a beautiful relic of a time gone by? The final conflict really looks like it's shaping up like this. On one side, you've got big tech. They are building a fully integrated system, what you might call a vertical stack. They own the AI models, the operating systems, the app stores for distribution, and the actual hardware you use. And on the other side, you've got Disney, with its legacy IP, its physical theme parks, and 100 years of storytelling history. It is a battle between a complete technological ecosystem and a legendary content empire. And here's one possible future summed up in a really powerful analogy. Disney becomes the Altria of entertainment. Now, for those who don't know, Altria is a massive tobacco company. It has basically zero growth, but it is incredibly profitable. It pays out a massive dividend to its shareholders by selling a legacy product to a loyal but shrinking customer base. Could that be Disney's future? A company that just profitably manages the decline of its own cultural relevance, selling nostalgia to the generations that grew up with it? At the end of the day, a bet on Disney is no longer just a bet on their next blockbuster movie or their next theme park ride. It's a much deeper, almost philosophical bet on human nature itself. When an AI can create a story that is perfectly tailored to your every emotion, your every desire, will you still choose the familiar, human-made story from a brand you grew up with and trust? Will we always prefer the comfort of a legacy brand over flawless, machine-generated art? That is the real question, isn't it? When we look back in 20 years, is Disney going to be something we just tell our kids about, a treasured part of our memories? Or will it have found a way to navigate this incredible revolution and continue to be a living, evolving part of our story? The answer to that question is going to define the entire future of entertainment.